Meyer. She is head of U.S. economics at Bank of America Global Research. Michelle, great to have you here today. I mean, the wage number was pretty strong. That's like 10% annualized.
Yeah, it was exceptionally strong, the wage number, but we have to be really careful reading too much into that. A lot of it has to do with compositional shifts in the labor market. So when you think about where the job cuts were concentrated, it was highly in leisure and hospitality, which tend to have lower paid workers. The fact that those individuals fell out of the labor market numbers means that overall wage growth, just from a compositional perspective, looks stronger. So unfortunately, we don't really have a good sense right now of wage growth. We haven't of the last several months ever since COVID hit, and we probably won't for some time going forward until we've had a more complete healing in the labor market.
But are you generally in the camp, Michelle, that thinks that those wage pressures are going to subside later this year? Because I read Jeffries thinks we're going to go, to be maybe 3% wage gains. But if we don't, I mean, if they stay elevated, then that's going to be a very different policy response from the Fed.
So the economics would suggest that the wage pressure should certainly moderate, just from the fact that the unemployment rate is still elevated. It's come down, but it's still high above where you should be in terms of full employment. So all else equal, that should lead to, downward pressure on wages, which we will find out after we've returned to some sort of equilibrium in terms of the composition of the labor market. So I would be in that camp as well, that you're going to see somewhat slow wage growth. That said, to your point, Kelly, if there is a surprise, if wages end up, remaining elevated or actually accelerate from here, that would then fuel the inflation narrative, which is already moving through markets.
And we've seen a number of different places raising their GDP forecast considerably over the past week since the Democrats took Georgia. And it looks like I'm seeing estimates on the order of $1 trillion of stimulus that is now being priced in, with GDP estimates of 6.5% growth for this year. Now, I don't know if that just got brought to a screeching halt with these comments by Senator Manchin to the Washington Post, where he's saying he's not necessarily on board with $2,000 stimulus checks. Now, that would only be $350 billion. But, that gives us a sense that maybe there's going to be more pushback to some of those big numbers than we thought. So how do you guys sort of put all that together and figure out how much fiscal stimulus is coming down the pike and what that's going to mean for growth?
Sure. So at the moment, our forecast for GDP growth this year is 4.6%. So it's strong. But we have a pretty weak start in Q1 with only 1% GDP growth. If another round of stimulus is passed, and I think that it is certainly leaning in that direction, the dollar amount we'll still find out. There's obviously, quite a lot of negotiation that has to go through before we can get that stimulus through the door again, especially after $900 billion was just passed. But if we get another round, call it in February or early March, that will then boost growth at the start of the year and provide an even bigger buffer to the consumer. And also remember right now that there's a lot of money already out there. There's over $1 trillion of what we would consider excess savings that's already outstanding. Now, there's distributional issues with that. A lot of it is kind of unintentional saving. The people who probably need the money most are not necessarily the ones that are sitting on those piles of cash. So more stimulus will help, but there's already a lot of money out there. So you have to think very carefully about the multipliers with every additional round of stimulus, how much it will then boost the economy. I think it will highly depend on how that stimulus is designed and how able it is to be targeted to the people and the parts of the economy that need it most.
Shepard Smith here. Thanks for watching CNBC on YouTube.